On Friday, March 10th, Silicon Valley Bank, SVB, collapsed in the second largest bank failure in US history, resulting from a run on deposits that doomed the bank's plans to raise fresh capital. SVB Financial Group, commonly known as Silicon Valley Bank, is an important institution in the tech industry, providing specialized financial services to startups, venture capital firms, and other players in the tech industry. According to the Federal Reserve, the bank had some $209 billion in assets as of December 31st. Customers tried to withdraw $42 billion on Thursday alone, which caused the bank to become insolvent by Friday. A sudden flood of withdrawals destroyed the bank's finances, resulting in a negative cash balance of nearly $1 billion by the close of business on Thursday. The Federal Deposit Insurance Corporation, the FDIC, took control of the bank via a new entity it created called the Deposit Insurance National Bank of Santa Clara, with insured depositors set to have access to their funds by Monday. Depositors with funds exceeding insurance caps will receive receivership certificates for their uninsured balances. Many of SVB's clients were venture capital funds and tech and healthcare startups with account balances well over the maximum amount insured by the FDIC. The regulator said these depositors would receive an initial payment next week, with the rest depending on what happens to SVB's assets. The bank's parent company, SVB Financial Group, had been racing to find a buyer after scrapping a planned $2.25 billion share sale Friday morning. Regulators weren't willing to wait as the California Department of Financial Protection and Innovation closed the bank within hours and put it under the control of the FDIC. The collapse of SVB has sent shockwaves through the tech industry, highlighting the need for financial institutions that are well equipped to serve the industry's unique needs. The failure has also raised concerns about the overall health of the tech industry and its reliance on a few critical players for funding. SVB's troubles may also affect other banks with similar depositor and funding profiles. Trading in PacWest, Western Alliance, and First Republic was stopped because of volatility after initially falling 40 to 50%. Trading was also briefly halted in Signature Bank after its shares fell nearly 30%, all of which happened in one day. SVB's collapse came just 2 days after Silvergate, a San Diego-based bank that catered to the crypto industry, said it would voluntarily wind down after customers withdrew billions of dollars. The Bank of England has also moved to put the UK arm of Silicon Valley Bank into resolution after it applied for 1.8 billion pounds of liquidity. The collapse of the SVB is a significant blow to the tech industry, as the bank is the banking partner for half of US venture-backed tech and life sciences companies and is a significant presence in offering credit lines to the $10 trillion private capital industry. On Thursday, its customers grew increasingly fearful of the bank's financial position when some startups began pulling their cash. Some venture capital groups acknowledged advising some of their portfolio companies to consider withdrawing some of their deposits from the lender earlier this week. In a statement on Friday, the U.S. Treasury Department expressed complete confidence in banking regulators to take appropriate actions to respond in response, and noted that the banking system remains resilient, with regulators having practical tools to address this type of event. As the tech industry continues to evolve, it will be crucial to address these issues to ensure the long term sustainability of the industry. Thank you.